Welcome, everyone, to the M&A Healthcare Insights Podcast. I'm your host, Mark Thomas. I'm also joined by one of my co-founders, Andre Ulloa, who is an executive advisor with us. And today we have a great conversation planned for you. We have a partner from Regal Healthcare Capital Partners with us to talk about the future of healthcare. And we have a few questions loaded up for that. And without further ado, I think we should just jump right into the conversation and get to the bulk of what this episode will be about. So I want to welcome Terry Wang to the podcast. Welcome, Terry. He is, again, a partner at Regal Healthcare Capital Partners. He received his BS in Finance and Management from Wharton and his MBA from Harvard Business School. So thanks for joining us.
Thank you. Hey, everyone. Before we start, just wanted to give a quick background on Regal, who we are. So I'm a partner at Regal. We focus on lower middle market healthcare services. We just raised our third fund, which is $415 million of committed capital. And we typically look for companies in the 10 to 40 million of revenue range, 2 to 7 million of EBITDA, but we can also start companies from scratch, back founders or management teams that want to do a buy and build somewhere. And we look across the entire spectrum of healthcare services.
Thanks, Terry. So let's start the conversation there. As you approach the market from an investment and an M&A standpoint, what do you see that is next for the healthcare industry?
Yeah, it's a great question. Look, I think there's a couple big trends that are happening. So first of all, we all know that healthcare is very expensive, and if we don't do something to control costs in healthcare, it's going to consume the entire federal budget. It's already the largest line item for state governments, for the federal government. And so there's a lot of attention and focus on how do we make healthcare more accessible, more affordable, more convenient, but the affordability piece is the most important. And so I'd say there's two broad areas I'd highlight. One is how do we start shifting services outside of the hospital? For a lot of services and procedures, it costs 2 times as much to do in the hospital as it does in an outpatient or in the home setting. So we spend a lot of time here at Regal thinking about what are the different types of services or delivery mechanisms that can shift care out of the hospital. The second big area is how do we move towards more of a value-based care system, right? Healthcare historically has reimbursed our providers on fee-for-service. Didn't matter whether you delivered quality care or not. Didn't matter if the patient got better. Didn't even matter if the patient came back to you. In fact, sometimes it was better if they came back to you because you could bill them again. And what we're seeing is slowly but gradually and persistently, the system is moving more towards value-based care. And that has a huge impact on how people get paid, but also on what services are valuable in healthcare, right? In a value-based care world, it is much more about preventative mechanisms. It's much more about taking care of patients before they become sick, and much more about thinking about the patient holistically, their behavioral health needs, their social needs, right? And not just about the end procedure at the end. So we spend a lot of time thinking about how is a company that we're investing in going to succeed in a value-based world, in a world where it is about preventing, the need for care versus just delivering care when it's needed.
So Terry, in that regard, so when you look at getting patients out of the hospital, right? We see the trend in terms of investment or integrating these systems. We've talked about this before, where you see the hospitals seemingly integrating a lot of these services that traditionally may have been third-party services, the home healths of the world. We see a lot of those hospitals over the years consolidating those services. So is the market pushing back against what I think you make perfect sense, what I think makes sense in terms of the patient, but is the hospital in particular, those integrated network markets, are they still consolidating, or are they seeing that, hey, this doesn't work if we keep these patients close to the hospital or we hold them accountable in terms of hospital the hospital visits or within the network of the hospitals?
Yeah, it's a great question. Look, in the recent history, I'd say the last 20 or 30 years, you've seen a lot of health system consolidation. So hospitals buying other hospitals and then raising the rates, or hospitals buying referral networks, so primary care doctors, right? And then raising the rates. And I think it's gotten to a tipping point now where payers, whether it's Medicare or commercial insurance payers, are fed up paying these high prices, right? And so a hospital system can still succeed acquiring and merging, but they're not going to be able to continue raising rates like they have in the past. They're going to be forced to operate in a value-based world. On top of that, a lot of more forward-thinking health systems and hospitals are voluntarily putting themselves into risk-based arrangements. So they have, for example, their own accountable care organizations, ACOs. And so now they're on the hook for the cost of the population that they're treating. And so I think more forward-looking hospitals, it's not just going to be about, well, let me gobble up the local doctor groups and raise the rates. It's going to be, well, how do I thoughtfully manage costs in a given population? And that may mean I acquire someone, or it may mean I partner with someone. But ultimately, the end goal is not to raise rates as much as I can, right? The end goal is to actually get these patients healthier. And oh, by the way, as I get them healthier, I'm going to profit as well.
And so does it stay fragmented to a certain extent in terms of those services? That because you have to have both, right? As you're saying it, you have to sort of move the patients away from the hospital network. And really, I think when I think of hospitals too, I also think about corporate consolidations, right? And running patients as you would customers through an industry agnostic corporation, right? Like these patients have different needs, and one product or service does not fit all. There might be certain things you can integrate into a larger corporation setting or a hospital integrated network, but in terms of the patient themselves as individuals, to treat them and make sure that they don't come back to those hospitals, you have to be specific about and bespoke about that treatment. So the question then becomes, how do you look at a patient? How do you see a patient in the future being treated in the best way, right? You value-based model it, but then are the services that they're getting, are those in markets that are fragmented or segments of healthcare that are fragmented?
Yeah, it's a great question. Avalier put out a study. It was actually eye-opening to me, and I think a lot of people, that, to your point, 72% of physicians are now either employed by hospitals or by a large strategic group like a Optum or even a healthcare private equity backed company, right? So when people say, "Oh, like healthcare is very fragmented," it depends. But a lot of the physician groups, it's actually not fragmented. They have already consolidated. I mean, this has been going on for decades now, but COVID actually really accelerated that consolidation. I think the open question is, going forward, are you going to see some of these groups break out, right? Because sometimes when a hospital acquires a group, it's like a 5-year or 10-year contract, and at the end of the contract, the group has an exit clause. And we actually have spoken to some groups that want to leave the hospital system, and that's actually an opportunity for investors or for even strategic buyers to help facilitate that transition out. But when you look at specialties like primary care, pediatrics, a lot of them are largely owned by hospitals. And that was because of that dynamic we talked about earlier. And so I don't have a great answer. I think it's going to depend on the market. It also depends on the specialties, right? So mental health, as an example, is not owned by the hospitals. It's a super fragmented space. You've got 700,000 licensed mental health practitioners out there. Dental clinics, still pretty fragmented. Hospitals aren't buying dental clinics, right? So it really depends on the specialty. But historically, hospitals have been buying either referral sources like primary care or pediatrics, right? Or the sort of highly reimbursed specialties, right? So cardiology is a good example, or orthopedics. To your other question around sort of what does the patient look like in the future in terms of how they interact with the healthcare system, my view is it's going to be much, much more primary care centric. So historically, we have reimbursed primary care doctors at a low amount, and they get paid at a low amount. And when you look at any medical school, the primary care specialties are not the most prestigious ones. And yet when you think about what actually drives, care coordination in healthcare, what can drive healthcare spending down, what can do the preventative measures we talked about earlier, primary care plays such an important role. And I think with a lot more of these value-based reimbursement mechanisms, you're going to see a greater emphasis on primary care. When I say primary care, it's not just a primary care doctor. It's also the physician assistants, the nurse practitioners that are playing an increasing role in the delivery of healthcare because there's just not enough doctors. The last thing I'd hit on is there is growing attention on social determinants of health. So when you actually dig into why is someone unhealthy, it's not just because they're not seeing the doctor enough. It's because of the environment that's around them, their job situation, housing situation, transportation, and so at the end, how much support they get at home, right? And so increasingly, I think healthcare is taking a more holistic view on the patient. And what's really interesting is you've got a lot of payers, for example, managed Medicaid plans that will say, hey, instead of just thinking about healthcare as a provider and a reimbursement schedule, let's actually work to make sure that our patients have housing, have transportation, have access to jobs, because that's going to have a lot of downstream benefits for their healthcare.
You as you talk through this, you touch on sort of one of the distinctions between you as a financial firm and as a private equity investor in these different segments of healthcare. And, how a hospital, it's almost, and I could be wrong in this, but it's almost like the hospitals have consolidated and they're trying to decouple to try to suit the patient and try to fit into the healthcare system in what makes sense. And the private equity understands that as they invest in healthcare. And so they create the platforms and they add on to these portfolios in such a way that is sort of moving us closer to that direction that you're talking about. Right. And I mean, we love it because it's ultimately about the patient. I think, it's about the patient and the caregiver. Ultimately, that's what's going to make the system work. It hasn't really been about that. And I think we still see strategics moving towards, shareholder focus, in that way. But I think as you build on the portfolio, are you looking at it this way? And are you seeing that, you're providing actually a benefit to the healthcare industry and a service to the patient?
Absolutely. I think, and it's not just us, right? It's I think any thoughtful investor who's investing in healthcare is aware about the major trends that are going on in healthcare, right? And where the system is moving. And so you've got to invest in things that are what we call bending the healthcare cost curve, right? If you are investing in something where it's costing the system more money or it's taking advantage of some loophole in the system, that's not sustainable. And you're on the wrong side of the healthcare cost curve. I think on top of that, there's an element of professionalization. And so if you can build a good healthcare company that has great systems, great infrastructure, a mechanism to be able to recruit and retain and manage providers, you're actually increasing access to care. And if you're increasing access to care in a way, for example, with behavioral health, that also lowers costs to the system, then you're actually creating a lot of benefit overall.
Mark, I mean, maybe to move it along, was there another big question that we wanted to pose?
Yeah. We've seen this trend of private equity entering the lower middle market, especially over the past 2 to 3 years. Are there any particular segments that you see private equity deploying capital from a geographic standpoint or segment in particular?
How about all of the above? So I think there's a couple of things going on. So if we take a big step back, right, you think about the different industries that a private equity firm could invest in. The reason why there's so much attention on healthcare is because it's a growing industry and it's huge. $4 trillion to spend in healthcare. And by the way, most of that is not on drugs or pharmaceuticals. It's on the delivery side of healthcare. And historically, healthcare has been dominated by health systems, nonprofits, or mom and pops. And so there wasn't really an opportunity for investors to get involved like they are today. And so when a private equity firm looks at the different industries they can invest in, it's like, wow, you've got sort of a large industry that's starting to open up to outside investors. You've got really interesting macro dynamics. It's growing. There's a lot of inefficiency, like we talked about, right? So if you can find the right play, you can grow quickly there. It's pretty recession resilient. If you were to plot the growth of U.S. healthcare spend versus GDP, what you would notice is GDP is a lot more volatile, and healthcare is durable. And so there's a tremendous amount of interest in healthcare from all types of investors. The problem is there's not a lot of healthcare assets for them to buy. And so, what are they going to do? Right. So they can start off by trying to find large assets. There's not enough. And so they start to move down market. Right. So they started with the large mega cap healthcare companies, not that many of them, go to middle market, still not that many of them, very competitive. Now moving into the lower middle market. Or if you're like Regal, we'll say, hey, if we find an interesting opportunity somewhere and there's not a quote unquote sizable asset, why don't we start something ourselves? Right. And so I think there's a lot of interesting things going on in terms of company creation, company formation to target areas of opportunity in healthcare. The other thing I'd say is historically when private equity has come into healthcare, they focused more on lower acuity type healthcare. So there was dental clinics, then physical therapy, but they've gotten more and more comfortable with higher acuity areas of healthcare, right? So you're seeing orthopedics, GI, urology, cardiology is the next big wave that people are talking about, right? And so there's a lot more appetite in, working with the higher acuity spectrum of healthcare.
And so in that sense, Terry, what we have seen too is that traditionally a private equity investor will have certain EBITDA or cash flow criteria, and that they are going below that criteria as well. Is that still the case? I mean, where, is there a floor in that regard? Because it starts to then feel a little bit more, even though these are legacy businesses, but it starts to feel a little bit more speculative, or you're basing it off of future value. And, and I'm wondering, will it continue to trend in that direction?
I think the short answer is yes. We'll continue to trend in that direction. And the reason why is because you have to remember these investors, these private equity firms, they've raised a lot of money. They've got to put it to work. That's how they make money. They got to put the money to work to make money. And so we've seen, a lot more flexibility in terms of, hey, we say we have a minimum of 5 million EBITDA, but this looks like a really interesting asset, and we will, refine our criteria, right? I'd say what's also interesting at the lower middle market is you start to get mixed up with growth equity, venture capital, et cetera. The boundaries become a lot less clear. But what is clear is that if you've got a good, interesting asset with a good management team, people will overlook the size criteria.
Yeah. I think that for us, it's been also a big focus on the caregiving, the labor, the personnel aspect of the business, right? We don't usually have a product attached to, or an tangible asset base to the businesses we sell. The businesses are really about selling the people, whether it's the people that work within the company or the patients that they service. And so in that regard, are there different ways of valuing these businesses that aren't traditional in terms of, multiples of EBITDA cash flow? Or are you looking at, okay, well, what am I gaining synergistically from these patients, or, in terms of market share, or from these caregivers in terms of, handling the operations?
Yeah, I wouldn't say there's a fundamental difference in the metric that's used. I would say it's more around distinguishing between good assets, right, that have shown, to your point about the labor shortage, that have shown a really good ability to recruit and retain their providers. And that usually means they've got great leadership, great culture, or some edge that allows them to bring these providers on. Those types of assets are going to command a higher multiple, whatever multiple you choose to use. I'd say another interesting area is primary care, right? And so primary care, a traditional fee-for-service primary care group may not be generating much EBITDA, but if someone looks at it and says, hey, actually, they can feed downstream a lot of other services, right? Then they're going to look at it maybe as a revenue multiple, right? And so, a lot of it is if I acquire something, what value can it generate long term, right? That it's not generating today. And as people get more and more interested in healthcare, they're willing to give credit for that longer term value that doesn't exist today.
Yeah, it's interesting as you use the term value. It has so many different definitions, right? And so touching on the idea of value-based modeling in terms of, let's look at a segment like like home. I think home health has been a big segment for us because of how fragmented it is. We went through a big round of value-based modeling conversions right before COVID, right? And then we saw COVID come about, and we saw that there was CMS support for these businesses. A lot of folks wanted to get out of the clinics, heal at home. And so, you see that trends, even in a pandemic situation, trends towards these third party or these outside of the hospital or clinic services. But in terms of value, how do you look at how does the CMS or the regulatory bodies continue to create the value for the patient, right? Or look at it in terms of paying for PDGM in certain respect. How do they create that, and how is that not at cross purposes with how you define value in terms of the investments that you're making? Because in some cases, those regulatory standards end up devaluing the business. It might create value for the patient, but the reimbursement, the payers, all of the things that have to be done in terms of the business infrastructure, the costs go up, right? The reimbursement, in fact, the reimbursement may be coming down in the upcoming year. So it's sort of like the payer bodies have a definition for value, and then you have a definition in terms of investing and what the value of the business is. How do those get reconciled?
Yeah, it's a good question. So first of all, CMS has explicitly stated a goal that by 2030, they want every Medicare life in some kind of value-based care arrangement, right? In other words, it's not necessarily fee for service that's driving reimbursement, it's outcomes. Now, historically, payers have micromanaged reimbursement in very complex ways. There's fee schedules, there might be quality of and incentive bonuses, et cetera. And I think that adds a lot of administrative burden to the system, and it doesn't always incentivize the right behavior. And I think where CMS is trying to go is saying, hey, rather than micromanage a really complex fee schedule, right, we're going to set up something that looks like an ACO REACH, which is the next generation of ACOs. And we're going to pay providers a capitated rate. And that provider basically has a budget by which they can manage spend for those patients. And they can then design their own reimbursement mechanisms, their own networks, right, to be able to reimburse the right providers, the right amounts to deliver the right level of care. So rather than a master fee schedule driving behavior, it's going to in some ways be more decentralized. It'll add its own complexity, right? But at the same time, I think you're going to see what the outcome of this is. You're going to see more care being more narrowly focused on a smaller group of providers who can actually generate good outcomes. And those are going to get not only more patients, but also be paid more because they're generating greater outcomes.
Yeah, no, and I think that in theory, that makes a lot of sense to us. It seems that in practice, and I could be wrong in terms of how it's tried to be incorporated into the market, for instance, managed care organizations, or as we look at Medicare Advantage, I think that those systems have not been to the benefit of the businesses that are in line with what we believe is the right process or way of handling the patient in healthcare.
So I would agree with you. I think historically what was missing was you needed a gatekeeper, right? So how historically have managed care or even Medicare managed healthcare costs? Well, they either manage it by decreasing the reimbursement, right? or by limiting the number of services, right? And instead, the move towards value-based care is to say the right model, most people agree with now, is to say, hey, can we shift the risk from the payer, right, into some kind of either primary care provider or some kind of intermediary gatekeeper that then says, okay, I don't have to live off of a set fee schedule, right? I can choose my own providers that I send patients to. I can negotiate rates with them, right? And I can be the one that incentivizes the right level of behavior. Because you're right. In the old world where the only way to manage costs was to limit care or limit pricing, that didn't work out so well, especially when you're limiting preventative type care. But in the new world where you can say, hey, I've got access to data now that tells me who are the right providers that are delivering the right kind of care, that are generating the right outcomes. Okay, now I'm going to incentivize those providers, right? Not just necessarily with higher rates, but also funnel more volume to them. That's how you start to shift the system.
Yeah, we had an client recently that their patients were all they were all HMO patients from Kaiser, and they had and Kaiser had set up what they called partnerships with these home health businesses, that were local to their area, and it worked out really well because Kaiser paid a fee for the patient based on visits, and those metrics allowed the provider then to say, okay, well, here are my costs associated with that. And there was enough of a spread there. I think that the challenge we see is that you have expectation that, we put all of this weight on the value of first responders and on, these caregivers that go in there. But they're not really getting paid much to do this work and to help other people. And it's hard work. And so, I think you have to there has to be a little bit more give on the amounts that are paid. And then you have to let the providers who ultimately set up their businesses because they truly care about the patient. I mean, sure, there's some bad actors in there. I think we've, flushed them out to a certain extent. But I think that in terms of what gets paid and how you let the operators manage those payments, we need to give a little bit more and abdicate a little bit more of the responsibility to these folks who have the patients directly in their sites.
Yeah, I would qualify that by saying in the past, right, different provider groups would always be lobbying for higher payments. And it was really hard for the end payer to say, well, who's actually doing a good job or not? And I'd say what's changed now is, and it'll continue moving in this direction, is we actually have a lot more visibility into data, right? So we like anyone with access to claims data will have a decent sense of, hey, a given specialist, how do they compare to another specialist in the same area in terms of the number of tests they're running up, in terms of the types of procedures they're doing, in terms of the cost of the patient after the specialist sees them. And that type of data and benchmarking facilitates, a payer or a risk-bearing provider group who actually is becoming the payer, right, to then pick and choose and incentivize the right kinds of behavior.
Terry, let me ask you this. So over the next 10 years, as these organizations that understand patient outcomes and value that, those will start to rise up. It'll probably squeeze out the providers that are less focused on that. And you have continued consolidation. What does healthcare look like in 2030 as CMS pushes towards that value-based care?
I think it's a great question. I think if you were to continue the trend now, I think you're going to see more and more consolidation, not necessarily into the health systems, but into larger groups. Because when you really drill down into what does value-based care require, value-based care requires deep investments in infrastructure, systems, and people, right? The people part, you're going to need, for example, more medical assistants to follow up on patients as one example. And for the more sophisticated groups that want to take risk, value-based care requires them to have capital as risk reserves. And so I think, I think you're going to move in a direction where, the one doc, two doc shop is largely going. It already has been disappearing, but it's going to continue to disappear. And I think it's an open question of, hey, like, are they going to end up in the hospital like they have historically, or larger groups? But I think the days of people being able to hang up a shingle, that's going to be really hard.
How does that pair with your statement on the fact that physician groups are exiting hospital systems, or you're seeing that trend at least?
Well, that's the important qualifier, physician groups.
That's fair.
So if you're a physician group and you've got enough doctors and you want to exit, right, you're still a group.
Yeah.
And that's the important part. So,
okay. Well, I think one touch on that too, Terry, is that what would you say to the physicians out there that, have held out? There's still those smaller groups, sub 5 physicians in the building. What do you say to them in terms of encouraging them to move in that direction? Just because they have their doubts, they have perceptions about the financial community investing in consolidation and loss of certain control, and ultimately not being able to do what they were trained to do in a way that gives them the autonomy over the patient. What do you say to them in terms of moving them in that direction, and who should they be looking out for in terms of an investor? What is the characteristic of that dynamic?
Yeah, it's a good question. Look, I don't think that an investor group or private equity is the right solution for all groups, right? Nor is it the only solution. However, I think if you're a small group, you do need to be investing in systems, technology, and data to prepare yourself for value-based care. I think that there is a path, for example, for you to get larger by yourself, by recruiting more doctors, or maybe doing a merger with another group that doesn't require an outside investor. I think it's going to be hard staying small in a value-based care world. And even something as simple as saying, hey, like we want to be able to afford to hire 4 or 5 medical assistants to follow up on our patients, to make sure they show up to their appointments, et cetera. Like that. That's one of those things where a larger group, whether they're backed by investors or not, right, is better equipped to handle. But I want to make it clear, though, there is a lot of technology and data solutions out there that are meant to enable physicians to stay independent. What we've seen, though, is the adoption of that hasn't been as high as people have hoped. And I think that's going to start changing as there's more and more pressure to move into a value-based world.
Yeah. One of what we talk about as one of the great attributes or benefits of working with a capital partner that has expertise in, the industry that they're investing in, is that they can take a lot of that burden away from the physician in this case.
Yeah.
And then you can centralize some of the administration.
Yeah.
And ideally you're really investing, as you said earlier, in management groups, in senior executives, in the physicians, in the owners of these companies, and hoping that you can facilitate what they do best, and take on some of the other burdens. I've seen those relationships happen. I just think that there's a perception that it's a lot of, the old LBO stuff come in, and gut the business and resell it.
And by the way, I also want to make it clear, there are a lot of bad apples as well in investment, right? So to your question earlier, hey, if you're a physician group and you're thinking about taking on an investor, what should you look for? What should you avoid? I would say a couple things. Be careful about a group that wants to borrow a lot of money to acquire you. The debt it's just like if you overextend yourselves buying a house with a lot of debt, it can work both ways. I think it's really important that your clinical philosophy aligns with the group that wants to invest in you, right? And look, we've seen bad apples out there where they're not going to do right by the patient, where they're going to, push for a lot of unnecessary care in order to boost their revenues. And in the past, you might have been able to get away with it, but again, we're in a value-based world, and so that type of stuff will catch up to you. It's bad medicine and it's bad business. I'd say watch out for groups that are just looking for a quick flip. A lot of the stuff that we're talking about here, it takes time. This is not this is not like I'm flipping a house and I'm in and out in a year, right? In fact, the quick flippers, they're more incentivized to do the bad things we've talked about. Do prioritize groups that are really, really focused on human capital development, right? That want to say, hey, how can I be thoughtful about recruiting clinicians or physicians, retaining them, providing a career path for them? Because that's incredibly important for any of these healthcare services companies. To your point earlier, these clinicians are the heart and soul of the company, and you need an investor group that appreciates and acknowledges that and is willing to invest in that development.
Terry, I think this is just really incredible information. You can see how thoughtful Regal is, and I'm really appreciative of you sharing these insights. I think that transparency is really the name of the game especially in the lower middle market. Now, I mean, there's so much sophistication there, and they can see us coming if we're not, completely open about what our intentions are and what the outcomes we expect are. I would just say that, when one of the concerns I have in the market with the clients that we work with is that they see these deals going on in the macro, in the large cap arena, and they're things like Amazon buying up digital, One Medical and digital health, and that's what's on our minds right now. And you start to get worried about where do I fit in all of this? Because it looks like the legislature is allowing these consolidations on a massive level, but ultimately Amazon, like with their pharmacy, for instance, they can't handle the specialized patient. They're not bespoke to the needs of the people that they're that they're taking care of. But they can do these large distribution networks, and they can definitely get things to people and all that. How do you reconcile that in terms of telling people, look, no, the future is going to be that you do what you do. It's not going to be that we try to create this huge, automated network of services, because ultimately customer service and patient bespoke services are what matter, and what would ultimately be valued in this market.
Absolutely. I'd say a couple things. Look, healthcare is inherently a very local service delivery mechanism, right? Even if a group is part of a larger group, at the end of the day, it's local, it's neighborhood based. Healthcare is inherently very human centric, right? It's not just about the procedure someone is doing or the test they're running. It's about the relationship they develop with that patient. And so there's always going to be a need. In fact, there's more demand than supply of healthcare practitioners by and large. I think that there is a question of sort of how are these practitioners organized? And I don't think there's going to be a one size fits all model or a winner take all model. There's not going to be the equivalent of the Google search engine that dominates, healthcare. Mm-hmm. There's going to be a variety of different organizational forms. We've talked about that today. Health systems, insurance companies, Amazon, private equity backed group. At the end of the day, though, what really matters is, do you have a group of practitioners that can generate good outcomes and lower costs in healthcare? And depending on the market, depending on the specialty, right, there's going to be different kinds of winners. But there's not going to be a one size fits all solution.
So at minimum, there will always be a need for smaller providers. Now, smaller is the question, how small? Maybe the better way to say it is more niche in terms of how things are developing.
Absolutely. And those smaller providers don't necessarily have to join a health system. In fact, I would argue the way value-based care is moving, it's actually leveling the playing field. Right. But those smaller providers do need to invest in their data, their technology, their clinical care protocols, so that they can operate more effectively in a value-based world.
Well, Terry, we can't thank you enough for joining us and having this conversation. It was a pleasure to hear your thoughts from the investment standpoint. And I can assure our viewers this won't be the last time we involve Terry in some of our publication here. So
if he wants to be involved.
Absolutely. No, this is a lot of fun for me. I feel like every time I get a question, it makes me rethink different things as well. So I'm honored to be on this and to be able to engage with you guys.
Yeah. Well, we got a pro interviewee at a really good cost.
There you go. So we're bending the cost curve for the podcast.
infinite a multiple here.
There you go.
So.
Well, for additional content, you can find us at www.mahealthcareadvisors.com. We have numerous videos and blog posts on the state of the market, what we're seeing from sell-side operators, and great interviews with people like Terry. So feel free to visit us there. You can find our other podcasts on Apple Music and Spotify, and we look forward to sharing more with you in the coming episodes. Thanks, everyone.